Hey guys, welcome back to Two Guys Talking Houses. Today we're going to get into a few topics. We're going to talk home inspection, we're going to talk the privatization of Fannie Mae and Freddie Mac and how Marc's opinion on that has actually changed, and we're going to get into what we're all anticipating next week, the Federal Reserve meeting and what might happen with interest rates. So Marc, I think we should start off with home inspections because that's something that is discussed a lot, and I have a lot of newer agents on my team that you're the lender for their deals, and they've asked me, should I send Marc the home inspection and ask his opinion? So, and the answer to that is no, but I think that it's a very daunting thing for a lot of buyers when they receive that home inspection report, because a lot of buyers are thinking it's going to pass. They'll ask me, is it going to pass inspection or fail inspection? And you have to explain, well, it doesn't really, there's not a pass or fail sort of system. You're paying somebody a few $100 up to $600 to come in, look at the house top to bottom, and write you a full report of all the deficiencies that they found within the house and things that you should address. So I want to get your perspective as a lender, because
Sure.
Obviously, sending your lender an inspection report could cause some complexity in the whole deal. But when you're doing a VA loan, a conventional loan, an FHA loan, what are you hoping for out of an inspection, and how much do you need to know from what comes from an inspection report?
Well, and so, yeah, it relates to lending. First of all, to address the don't send it to your lender thing, some loan officers don't know not to send that to the underwriter. So
Right.
if you get a home inspection, your home inspection is going to pick out everything. Like, well, that, wall plate is upside down or something on the plug, or the switch goes the wrong way or something. It's anything and everything they're going to pick
minutia.
out.
Yep.
And there's a lot of really silly stuff that doesn't really necessarily need to be fixed. But if you send it to an underwriter, guess what? You're going to have to fix all that to get your loan approved.
Yep.
And so that's why we often tell people, like, hey, I know I've been doing this a long time, not to send it to the underwriter, but people have, and it's killed a deal. So that's not good. Now, the second part of that, though, is there are some things that we need to know. And when I look at a house, somebody says, I want to go buy, I'm looking at 123 Main Street. Okay. I pull it up and look at it, and if there's giant holes in the wall, or there's cracks in the brick because the foundation is moving, like all those kind of things I'm looking for, because different loan types require different things. The FHA and the VA, I always tell people, it's like having your dad there. Your dad's going to ask, are there smoke detectors in the kitchen? Like, hey, that railing over there, it's got more than 3 steps, and or the stairs have more than 3 steps, and the railing's gone. There's nothing there. You could fall. Like, man, in a fire, those burglar bars, if you can't open them from the inside, like, they're not, you can't get out. You're trapped. And so we often say, like, yeah, it's like having your dad there.
Yep.
The things that he would call out, nothing crazy, but things that he would call out. Now, conventional loans are a little more relaxed, and it's not as big a deal. But from that standpoint, yes, a lender should know if, hey, the inspector called out foundation issues.
Right.
Yeah, before the appraiser goes out there, we should probably address that issue.
Exactly.
If the roof looks like it's fallen off, that's going to be an issue, kind of no matter what kind of loan you do.
Yep.
So, but you're really involved in the home inspection. So, what do you look for? I mean, what are some, if somebody's never bought a house before, right, and they're doing home inspection, what should they pay attention to? What should they look for?
It's a great question, and I get this question a lot from my clients, or this, I should say demand rather than question. They're a first-time home buyer, and I don't fault them, because I truly believe that my job as an agent is to protect the client and to educate the client and not be overly salesy. Yeah. I want you to buy a house with me, whether or not it's this house or not. And if I demonstrate myself appropriately, even if a house has a horrific inspection and we need to terminate the contract, chances are you're going to move with me to the next house and we're going to close on that one. So for me, I kind of look at it as an opportunity to be a teacher and a protector to some degree. Mm-hmm. And what I'll tell them is, a lot of clients, back to the demand, they'll say, here's a 44-page inspection report. I want the seller to fix everything in this. And I'm like, okay, that's not realistic. As you mentioned, the face plates on the electrical outlets are upside down. Some of the stuff, the home was built in the 80s, and the code in the 80s was different than the code today. There's GFCI requirements for the switches and electrical receptacles and stuff like that. They're not going to go in and fix every single thing. What I tell them we're looking for is what I call the big four. And we'll go top to bottom. So we're looking roof. Oh, do we have any major problems with the roof? We're looking electrical. Do we have any major problems with the electrical? Because I know there's some companies that put in the breaker boxes that are no longer in existence, and it's very difficult to get a loan approved if you've got one of those type of boxes without having some work done. We're looking at plumbing, and we're looking at foundation. To me, and maybe you could add a few more to that, to me those are the big four that if we have major problems with one or more of those four, we might want to consider asking the seller for some concessions in the deal.
Yeah.
And that can look like a couple of different things. We could say to the seller, okay, the roof probably needs to be replaced within the next year. It's got some serious deficiencies. We would like the seller to contribute. Let's say a new roof costs 15 grand. We're buying the house. We're willing to brunt half of that cost because we're going to be the owners, and we expect the seller to cover half of it. So we ask the seller for a $7,500 concession towards the closing.
Right.
And what that means is that essentially the buyers rather, can save $7,500 from the closing table. You keep $7,500 in their pocket. Right. So that's $7,500 less dollars that they have to bring to closing. So that's or we could say we want the sellers to put a new roof on the house before we close.
Right.
Those are your two options. If you've and I find that a lot of my buyers, excuse me, especially the first-time home buyers, they're opting for the credit towards the closing because they don't have, tens and potentially hundreds of thousands of dollars saved to do a big down payment, to pay closing costs and everything associated with buying a home.
Right.
So if they can get the seller to offset some of those expenses, they tend to go for that option rather than asking for the repairs. So those are the big ones that I'm looking for, and then we review it together. And there's been times where we reviewed it and I say to a buyer, hey, this house is probably not the one for you.
Yep.
This house is probably the house for an investor who's used to fixing roofs, completely redoing the plumbing, completely redoing electrical, doing foundation repair. They're probably going to buy it for a much lower price. They're going to buy it in cash. They're going to fix it up, and either they're going to flip it or they're going to put a tenant in there. Yeah. So this may be that sort of situation. Or, there are some things that I think need to be addressed. So let's address that in the form of a seller contribution or in a request for the seller to repair. But the whole pass or fail thing is something that comes up a lot with me, where clients ask, "Is it going to pass inspection?" I say, "This is not this isn't high school. There's no A, B, D, C grading. It's going to be, here's everything wrong with the house."
Yeah.
And it's also, a lot of people are like, "Well, this house was built in the 80s. I could just go get new construction and the house would be perfect." Well, I sell a lot of new construction,
right.
And I can tell you I've seen 30-page inspection reports on a brand new build that the home was completed on Tuesday, the inspection happened on Wednesday, and you still have 30 pages worth of stuff to get through.
You know what I tell people about that? So I'm a little bit older than you.
Yep, just a little bit.
Just a little bit. And so I don't know, I've owned 7, 8 houses, whatever it is, and 2 of those were brand new. And those were the 2 I had the most problems with.
Yep.
Because it's got a million parts. What are the chances they put it all together right the first time?
Exactly.
And that's what surprises people. They think new construction is perfect. It's not. Go get your inspection, an independent inspector that you pay. And it's funny now, the house that we have now, the house we're in right now, actually.
Yep. This current one we're sitting in.
Yeah. And we bought it using one of your coworkers, another agent in your office. And so when we talked about it, it was like, well, we're going to get an inspection because we want to know, basically a to-do list.
Yeah.
We knew it needed work. We knew it wasn't going to be perfect. We just needed to make sure it got a loan, which it did. And that, for us, it was just a to-do list. Hey, you need to fix this eventually. This probably needs addressed right now. There were some foundation questions. We just did that 5 years later.
Exactly.
And it's like, it's not the end of the world stuff, but hey, this is a hazard. The pool needs to be redone or whatever. The fence is leaning the neighbor's yard. That kind of stuff, that probably need to be done first.
Exactly.
And, or a plumbing issue or electrical or the AC that didn't work at all when we bought the house. On an FHA loan, you can't do that.
Right.
That kind of stuff. They're going to come in and turn on the switches and the appliances and all that. Conventional loans, not so much.
Right.
And so, they don't really, I don't want to say they don't care, but unless it's a glaring issue, they're not going to call it out on an appraisal.
Yeah.
The home inspection is kind of like your preview of what might get called out on an FHA or VA appraisal.
And I've noticed too, because we've worked a couple of VA deals together where it was very difficult, especially with condos.
Yeah.
Because there's only certain approved condos that can get, through the VA process. And so
There's
that's
a list.
Yeah, exactly.
If it's not on that list, then you got to get it on the, and if anyone's dealt with the VA, they know that the VA is not fast.
No.
They're not known for efficiency. And so, to get another condo complex, or even new, old, doesn't matter, on the list can be a challenge. So you're kind of limited to what's there now.
Yeah.
But yeah, condos are a whole nother episode.
Yeah, exactly. And we should dive into that. But, I think in the same vein, speaking of government efficiency, since we're talking VA, we probably should get into the privatization of Fannie Mae and Freddie Mac. Now, we had this conversation, I guess it was about a month ago, and you said that your opinion has changed since doing some research.
Yeah.
So what are your thoughts on the potential privatization of Fannie and Freddie?
So quickly, I'll take you through kind of how we got here. So first of all, Fannie and Freddie, they're government-sponsored entities, and so they were basically, they're private companies that are operated under guidance, until 2008. And in 2008, a lot of things happened.
Yeah.
A lot of losses. So we bought a house in 2003, and all we had to do was put 5% down and have a 680 credit score.
Right.
And we didn't have to show anything else. They called it a fast and easy.
No income verification.
Didn't matter. So, and that was great, right? It was super easy, super simple, but you can see how that might cause problems down the road if that person didn't really make the money or have the income or have the assets that they claimed to have.
Right.
And so that was really what was part of the downfall in 2008. And so what happened is those were Fannie Mae, Freddie Mac loans. Those are conventional loans that were done. And then some of the conventional loans were done as an expanded approval. Okay. So maybe it's not a perfect loan, but it's kind of like an A-, but that got thrown in with the A stuff and the A+ stuff. And so all of that stuff doesn't perform the same.
Right, sure.
And so as losses started to mount, the government came in and said, hey, we've got to bail you out. And in fact, to do that, you're going to have to give us 79% of the equity in all of your investments. In other words, now the government has to own, almost 80%. And they gave them $400 billion. So, and took over the control of Fannie Mae and Freddie Mac. And that's how it's run since. How many government agencies have you found that are highly efficient?
I still am looking for one. If you found one, let me know.
Right. And so that's part of the problem. I mean, going through that and having like, oh man, it's so bad that the government has to take it over in 2008. My first response when someone says, hey, they're gonna take them out of government control, you're gonna privatize them, I'm like, hey, that sounds like a great idea.
Yeah.
Wrong. It really isn't. And what I didn't consider is just that they've been running for 16 years now under the government.
Yeah.
And, to privatize them, they would have to hire an entire management team and a finance team and a ton of people to manage this. And then they've got to basically ungovernment this entity.
Uh-huh.
They've got to make it efficient. And
maybe the Department of Government Efficiency will have something to do with
that. Right. I mean, and that's just it. The thing's actually got to make some money.
Yeah.
And it's not a new company, right? But it's sort of a new company. So right now, those investments have like an A rating. But let's say now they're in a new venture, that might get, Moody's might rate that an A-.
Right.
Or it's not quite as, so we're going to devalue those investments because now it's private instead of the government backing it.
Okay.
And so in doing all that, and in the meantime, in the 16 years that's passed, guys like Jamie Dimon came along for Chase, and he's like, you know what, I really don't need Fannie Mae and Freddie Mac. I'm going to create my own investment. my own mortgage-backed securities. And so now it doesn't have to go through them.
Okay.
And so the same guidelines, same everything. So then if things went really south, he could sell it back, Fannie
To
and
them,
Freddie.
yeah.
But, it kind of, and probably do it cheaper because they're already efficient. They're already good at what they're doing. And so this big, slow-moving government entity becoming a competitor with people like Chase is just not realistic.
Right.
And it's going to cost money to make that happen because now we have to pay people, we have to make a profit. We're going to, unfortunately, it would cause rates to go up.
Okay.
Because there's more cost involved than there is today.
And is that why your opinion kind of changed? Because you think it would make it less efficient and cause rates to go up?
It is, and I hadn't really, after we had that conversation, I thought about it. I was like, maybe this isn't such a wise idea after all.
Yeah.
And then I did some research and listened to some podcasts and, all those things that we should do and said, what seemed like a great idea. I mean, I'm all for deregulation, make things less complicated, and all of that. But the reality is that the cost to the consumer would likely go up. Already, government loans are cheaper interest rate wise. FHA and VA are always going to have a lower rate than a conventional loan. And part of the reason for that is because, Ginnie Mae, which handles government loans, VA, FHA, Ginnie Mae is a government entity as well, but it's backed by the government themselves. So VA and HUD back those loans.
Okay.
There's less risk in those loans. They know that the investors know they're going to get their money.
Right.
Because the government's going to back it.
The government's going to guarantee
exactly. And that's kind of, and that's why, as I thought about it, I thought, man, this seemed like a great idea at first, but maybe not. It just, and it's going to take years to get it done. I mean, it's not something that, just day one, Trump takes office and boom, they're not
private entities. Yeah.
They're private entities. No, it's going to take, it could take some legislation. It could take years to create this. And then, at some point, somebody's got to get on a plane and go to New York and say, hey, Moody's, what do you think about this idea? What are you going to give us as a rating? And they're going to give them a preview rating. It may be a B.
Right.
We don't, it may be, a not prime class investment grade entities or investments as they are now.
And so basically, with that B rating from Moody's, that would be, as you're saying, what would cause the rates to go up because it's seen as a higher risk sort of investment if it has an A- or a B rating? Is that kind of the gist
that's
of it?
part of it, but if I've got mortgage-backed securities in a bundle and I'm going to sell it to you and it's got A+ rating, right?
Yeah.
It's probably worth more to you
Sure.
than something that has an A- rating.
Less defaulting and stuff like that.
Less defaulting, it's higher quality, investment. And so therefore you might pay more for that.
Right.
And so if the rating of the entire portfolio, and we should talk about that a second. So there's $12 trillion worth of mortgages out there. Right now, about $5.5 trillion are under Fannie and Freddie.
Okay, wow.
So that's a huge
percentage
of the market, right? So now if you go, and now they're run by a private organization, so now that investment's worth less.
Right, and it's a $5 trillion investment.
Let's say it's worth 5% less. That's still a ton of money. And so, you can't, it's going to really mess with the market if all of a sudden it's worth less.
That's interesting. And I think it would be helpful if you could explain the difference. Everybody puts Fannie Mae, Freddie Mac, and then to a lesser extent Ginnie Mae kind of in one bucket. But help me and everybody else understand, what is the difference between Fannie Mae, Freddie Mac, and Ginnie Mae?
Right. Who's writing the rules is really what it comes down to. And so, if you're investing trillions of dollars, right, in some mortgage-backed securities, you'd like to know that all those loans were underwritten to the same rules.
Right.
We've got to have a job history, we've got to have income, debt to income ratio needs to be below a certain amount, credit score is this, that sort of thing, right? You want to know that all of that stuff was done. You want to know that your A-grade paper doesn't have 300 credit scores in it, That,
Right.
You got to work to have a 300 credit score. I mean, you really got to not pay
That's
stuff.
almost as hard as having an 800. Yeah.
Right, exactly. I mean, it takes some effort. So the point of all that is that Fannie Mae and Freddie Mac, we'll just say basically they write the rules. They
Okay.
write the guidelines. So they do back the mortgages. They guarantee to us as a lender that if we sell to Fannie Mae and we follow the rules, then they're going to have reps and warrants or warrant the loan. Basically, if it defaults, it's not our problem.
Right.
So now FHA and VA are guaranteed by the government. They write their own rules. FHA and VA are typically pretty similar to each other. Little looser rules because the federal government is standing behind those, backing them up, and paying if there's a default.
Right.
On a conventional loan, the mortgage insurance pays if there's a default.
Right.
Right? And the investor is made whole through that. But there's on the government side, it doesn't matter. Like they could, whereas FHA mortgage or conventional mortgage insurance might cover 15% or 20%, 25% of the loan. Right? If they take a 40% loss, then 25 of it might be covered already.
Gotcha.
Right? But the government is covering it no matter what. If you have a VA foreclosure, they owe $100,000, they got to sell it for 80. They're fine.
Right. Exactly.
And what if one of those PMI, private mortgage insurance companies, goes out of business one day?
True. Yeah.
Then what? And so again, it's the rates on FHA and VA are better because you don't have to have quite as high of a yield to make that happen. That rate could be at 6.5% or 6%, whereas the conventional rate might be 6.5% or 7%.
Right.
Because the investors are looking for more yield from that.
Gotcha.
To attract me to invest in something that's riskier, you got to pay me more.
Higher yield. No, that makes perfect sense.
Right.
And it would make sense too that the privatization would cause some growing pains that would
Right.
probably ultimately result in higher interest rates, which right now affordability is the topic of everybody's on the front of mind for everybody, because a lot of people are seeing that the amount of money it takes to buy their first home is more than they had anticipated, and certainly more than it was a couple of years ago when rates were in the 2s and the 3s.
Yeah.
So, if we did something, if we threw a monkey wrench into the deal, then, with rates already around 7, if it bumped them up again, that would probably not be so great for the home buying market.
And really what it amounts to is that, these government entities, there is a cost. Like, there's a cost along the way. There's a reason that the mortgage-backed securities market is, we're following a 5.5 right now.
Yeah.
Well, your rate's not 5.5 on your mortgage. It's 6.875 or 6.75 or whatever. Or maybe you buy it down to, something cheaper, and that's fine. I think the national average today is like 6.87 or something like that. And so, and if that's your rate, well, now it might become more, because between that 6.875 or whatever it is and the 5.5, there's quite a difference there, right?
Right.
All of that is because people are making money along the way.
Exactly.
Right? There's fees, there's costs, it costs money to service, a loan, to collect the payments, to, if you don't make your payment, to collect that payment, to foreclose, all these things, cost money. Well, it's going to cost more money for a private company to do it, who actually has to make money.
Make a profit.
More money.
Right.
So yeah, they can run kind of inefficiently right now as they are.
Yeah.
It's cheaper than running it as a private organization.
Interesting.
And,
so talking about rates, I think that's the perfect place to land the plane today. We do have the Fed meeting coming up next week, Wednesday, I believe it is, on the 18th. Are you still hearing that it's going to be, 25 basis point reduction in the federal funds rate? Are you hearing anything else from that, or?
So, in about a month ago, maybe a month and a half ago, I think people were fairly certain, but they were starting to question. And again, we're following things like job numbers, right? So if the job numbers got, the most recent one met expectations, right? That's what they expected. But that's not really what happened, because a lot of those jobs were not created because, of the economy and business is doing well and all those things. That's not where those jobs came from. A lot of them came because, well, let's say Boeing, for example.
Yeah.
Boeing makes airplanes. They all went on strike.
Yeah.
And so, I don't know, what was it? 10,000 people or something? A lot of people. So some of those jobs came from those people going back to work.
Right, right.
We had a couple hurricanes come through, in fact, through the South, Florida,
Twice.
Carolinas, places that never get hurricanes, got hurricanes. So, and a lot of those people are going back to work.
Yeah.
Asheville, North Carolina, because we were going to go there on a trip, and we ended up canceling the trip because we thought, we're basically to be in the way of progress.
Yeah.
So, but they just got water like 2 weeks ago.
Wow. And that's been some months, yeah.
Yeah, you can't work without water. So, a lot of those people just went back to work because they now could, because they could, the civilization as it's known and so in reality, they only really created about 170,000 jobs, not 270.
Right. You're not creating jobs, it's just people going back to work.
Right. And so, and what they're looking for us to lower the federal funds rate and is slow down a deterioration in the job market, deterioration in various metrics. So they go, okay, if we lower this time, it's not going to cause massive inflation, which is what they're afraid of.
Right.
So, and even if we look at the statistics and the probability charts, and we're at something like 97%. There is a 97% chance right now, according to experts smarter than me, which is a whole bunch of people, right, that we're going to see a quarter point rate cut.
Okay, so that's the consensus by a country mile.
And we always, we record these things on Fridays. We're talking about, next Wednesday, the 18th. That's the next meeting. And they're every 6 weeks.
Yeah.
So, and as the farther we go out now, we're starting to see, well, what's going to happen in 25? Well, at one time, gosh, they were talking like, we're going to have 5-6 rate cuts. And well, now we're looking at, it's a little more, I don't know, partially because of the election. Partially because we don't know what that effect's what effect that's going to have, on the economy. And what is Trump's administration going to do differently? Because surely they'll do something differently than what Joe Biden's doing.
Right, sure.
Whether you like what Joe Biden's doing right now or not.
It's going to be different. That's one thing you can be assured of. It's
surely going to be different. Yeah, so until some of that uncertainty gets played out, then, like what we were just talking about, privatizing the government-sponsored entities.
Yeah.
Fannie and Freddie. He said that, but to fulfill his campaign promise, he's really just got to try.
Right.
Well, all right, great. Is he actually going to do it? Don't know. If he does it, it could affect things for sure. If he tries it, probably not going to affect things nearly as much.
Yeah. Do you see continued friction between Trump and Jerome Powell in the next year? Because I think he's got his contract is up until 26, right? Yeah.
I think it's July of 26, and so I think there's Trump would love to have the federal funds rate come down.
Yeah.
He would love to have just things flowing freer than they are right now.
Right.
In general, and Powell's a little more conservative. Mm-hmm. Some people say like, oh, it's a bunch of old guys sitting up there, and it's probably not too far from the truth.
Yeah.
But they're also being very cautious about what they're doing. They don't want to jump out there and drop the federal funds rate a full 100 basis points, a full point,
and then spike inflation.
Yeah,
again.
we could have mass pandemonium there. But just we always say rates take the elevator up and the stairs down.
Right.
Well, the same thing with the federal funds rate. We don't you don't want them to go down the slide. Right. You want them to take the stairs.
Exactly.
If you think of the playground, the metal slide that we've all burned our legs on in the middle of the summer, right? We don't want them taking that. We want them taking the safe, easy stairs.
Yeah. And it's not as fast as a lot of people would like, but it's when you look at the real estate market as a whole, in what is a healthy real estate market, having rates come down at a reasonable rate is the appropriate way to do it. Because if they take the slide down, as you said, and millions of buyers re-enter the market, you're going to have that same buying frenzy that you had, which for me, I sell houses. Like, I would love to see a buying frenzy.
Right.
But I'm speaking to being the actual buyer.
So let's turn this around, though, and ask you, what do you think the ideal rate is?
So I think in a healthy market, the ideal rate that we could get to would be somewhere in the high 4s, low 5s. And I think that would be because when you have rates where they are now, a lot of people are living in their house. I think I saw a statistic that 70% of people have a rate of 4% or less. So a lot of people are not wanting to sell because if you sell, you probably have some equity in your house, but then you have to turn around and buy another house at a 7% interest rate. That's going to substantially increase your monthly mortgage payment. So I think conversely, when they're at 2 and 3%, you have this buying frenzy where if you're, Joe Smith, the first-time home buyer with his wife and his 2.2 children and golden retriever, he's having a hard time competing with people buying a house, and he's making offers on 7, 8 houses and getting turned down, and it takes months until he can finally buy one because you have so many people in the market. You also have people buying, investors buying because they can get such cheap loans, and they're wanting to, even BlackRock and these other big entities buying homes and renting them out. So I think the sweet spot is somewhere between where we are now and where we were in 2020, 2021, which is why I say high 4s, low 5s. I think that would entice a lot of buyers to re-enter the market, and it would also entice some sellers to sell, but it wouldn't be, the scales wouldn't be so tipped one way or the other that it's either a massive seller's market or it's the what's that? The blue lights on at Kmart, and everybody's running to the aisle 6 to grab as much as they can.
Yeah, and it's funny, here I am, the old guy, right, in the room. I'm more of the 5.5, 5 3/4. You know, 6 will really start getting. Once we're down to low 6s.
Yeah.
Now consistently, then I think things will start to break loose. But I mean, the ideal is probably 5.5. 4 might produce the frenzy in my mind.
You think? Okay.
But that's why we do this. You have an opinion, I have an opinion,
Yeah,
we'll
and you've been through more cycles.
Right.
Yeah, and you've been through more cycles than I have in this industry, and so it's interesting because to me it seems like it's from my clients, the conversations I'm having, they're like, I want rates in the 4s. Well, 4s is a little bit unrealistic, but I think 5. So I'm at, let's say, low 5s. You're kind of at mid to high 5s, but I think the consensus that we can agree on is if a 5 is in front of the number, that's probably going to cause. I mean, my phone's ringing. I'm averaging selling between 3 and 4 homes a month right now.
Yeah.
And I've got listings, I've got buyers, I've got and agents that are putting the work in are seeing the same results. There's nothing special about me. I just do the work that I'm supposed to do. But if you put the work in, even 8 months ago, we were working hard and still really not closing much. So it's I'm starting to see things break loose, and if we could get them in the 5s, I think next year will be a tremendous year.
I think that's something we need to talk about in next week.
Yeah.
Is where are ideal rates and where is the market in balance and things like that.
Yeah.
I think that would be that'll be a great another episode.
Yeah. What is the ideal interest rate? And we can do some research and come back with that.
Yeah, I think so.
But until then, I think that's a perfect place to leave it.
I think absolutely.
Guys, thanks so much for watching this episode of Two Guys Talking Houses. If you want to get in touch with Marc or myself, you can scan the QR code that's in the top of the YouTube banner. You can drop a comment below. We'll respond to you. We love to hear from you. And if you're looking to buy a home or get a mortgage in the state of Texas, certainly contact us. If you're looking elsewhere, we have a great referral network. We will see you next week. Have a wonderful weekend.